target allocations to real estate, reversal of the denominator effect, and the role listed REITs play in real estate portfolios. This month, we are digging into how institutional investors are positioned heading into 2025. Welcome to the Real Estate Reel from Cohen & Steers. Cornell University's Baker program in real estate and Hodes, Wild & Associates recently published their 12th annual Institutional Real Estate Allocations Monitor. It surveys 186 institutions across 25 countries with approximately $16 trillion of assets under management, of which almost $1.5 trillion is real estate assets. This leads me to the first thing I'm watching. Target allocations to real estate are up nearly 200 basis points since 2013, representing an increase of over 20%, as you can see in this chart. Target allocations remained at 10.8% in 2024, but they are expected to decline by 10 basis points to 10.7% in 2025. Given the headwinds facing the sector in recent years, investors have largely remained on the sidelines. However, real estate remains an important allocation in institutional portfolios, and investors generally believe that real estate is likely to deliver strong performance over the next cycle. The second point I'm watching: investors shifted from over-allocated to under-allocated to real estate over the past 12 months due to what is called the denominator effect. The denominator effect refers to a situation where an investor's allocation to private real estate, for instance, appears to have increased as a percentage of their overall portfolio because other asset classes within their portfolio, like public equities and bonds, have significantly decreased in value. This causes the private real estate portion to represent a larger relative share of the investor's allocation, even if the absolute value hasn't changed materially. This is what occurred in 2022 as private real estate valuations rose while public valuations, including both equities and bonds, declined. This pushed actual average allocations to real estate to their target allocations, but almost 40% of institutions reported that they were over-allocated. This followed an 8-year period when they were under-allocated to real estate by an average of 100 basis points. Fortunes reversed in 2023 and continued in 2024, with public valuations rising while private CRE valuations declined. Net-net, we believe unlevered private real estate valuations are down 20 to 25% since mid-2022. As a result, while target allocations remained flat in 2024, actual allocations to real estate decreased 60 basis points to 10.2%. Nearly 50% of institutions now report they are underallocated to real estate in 2024, versus less than 30% that say they were overallocated. Finally, we recently explored the benefits of adding listed REITs to a private portfolio of real estate. It appears that more institutional investors are seeing that benefit too. The 2024 Institutional Real Estate Allocations Monitor notes that 39% of institutions invest in REITs, up 3 percentage points from the year prior. This ranges from 10% of private pensions to 71% of sovereign wealth funds and government-owned entities. The average exposure to listed REITs within a portfolio of real estate is 11%, with insurance companies having the greatest exposure at 14%. Liquidity is the primary reason for investing in REITs, cited by 67% of investors in the survey, up from 46% the year prior. We think this increased focus on liquidity is likely indicative of gating that occurred in many private real estate funds, whereby investors have not been able to withdraw their money this year. REITs, as part of the core real estate strategy, is the next highest reason for investing in listed real estate at 47%. Again, we think this makes sense as we previously argued that at certain allocations, listed real estate can help reduce volatility, increase returns, and mitigate drawdown risk of an overall portfolio. And accessing other niche strategies is the third reason to invest at 28%. We think this is likely underappreciated, given approximately 60% of listed REIT market cap is in next-generation strategies like data centers, cell towers, and single-family rentals. Subscribe to the Real Estate Reel via the link on the screen and tune in next month to see what we're watching.